Waiting for that clock to start, Yonah. Let's get it going. There we go. Welcome to the Infinite Wealth Podcast. I'm Cameron Christensen, along with our co-host Anthony Faso. Guys, and today I am excited because we have the cost segregation king, Yonah Weiss. Yonah, thank you so much for joining us today.
You're welcome. Thank you guys for having me. It's a pleasure to be on the show.
Absolutely. And I appreciate you staying up late because I think you said it's 10:30 on your time. So appreciate the effort, man. But hey, I've been following you. I mentioned this before the recording, as I've been following your content for a while now, and very much appreciate the caliber of content and the education that you provide. I'm excited to get you introduced to our listeners. But before we dive into kind of cost segregation, man, share with a little bit about your background. I love the story of kind of how you got started.
Sure. I was actually, I've only been in the real estate space about 9 years or so, but prior to that, I was a teacher for about 15 years.
Nice.
And that really has been my passion for as long as I can remember. You know, even in middle school and high school, I was a tutor and did youth group things. And that role was always passionate for me. And being a father of 6 kids, you're always teaching at that point. But at a certain point in time, I realized pretty abruptly that the teacher salary I had was not cutting it. Was not fitting the bill, and we had unfortunately some major kind of health crisis in our immediate family, which huge medical bills that weren't covered by insurance, things out of left field that just I knew I was literally underwater and in debt, and realized I need to make some proactive changes and just put it out there to friends and acquaintances. And real estate kept coming up as just a field to go into, because I wasn't really interested in getting any formal education, another degree or anything like that. And so I was just, what has a potential, it's like there's no ceiling essentially, and there's no requirement of having kind of any formal education. And real estate kept coming up. So one day I met a friend of mine, and he mentioned that he was in the mortgage, doing commercial mortgage brokering. I was like, what's that? I didn't really know much about that at the time. He's like, why don't you come work with me? I told him I was interested, looking for a new opportunity. He's like, come, I'll teach you everything, you need to know. And that's really how I got started in real estate, literally sitting in my friend's office, doing cold calls and underwriting and learning the lingo and the jargon of commercial real estate, which is crazy, all the acronyms and LTVs and cap rates and all that stuff. And then I just got really interested in the whole field. I got my broker's license, did some rentals, some sales, some fix and flips, a bunch of different things until about 7 years ago or so. So I was, doing this for a couple of years, doing a lot of networking. And this company, Madison Commercial Real Estate, Madison Specs, which is the biggest cost segregation company in the country, reached out to me, and they were looking for someone to do business development. And I was like, okay, hey, listen, I'm open to opportunities. Let's see what this opportunity brings. And the truth of the matter was, I didn't really know. I didn't have an accounting background, didn't have a finance background whatsoever, but I did have this teaching background, which meant that I have a pretty good skill at learning complicated things and being able to teach them in a simplified fashion. And so I was like, what's this cost segregation thing? I never heard of it before. But the experts, at Madison really kind of took me under their wing. And very quickly, I learned it and started teaching it. And essentially, that's what my role has been for the past 7 years is really just educating people about this incredible, tax savings strategy.
Man, I'm excited to dive into it. So for our listeners, tell us what is cost segregation?
Well, it's a really weird name for essentially a advanced form of depreciation. So anytime you buy a property, besides for your primary residence, if it's a business or investment property, you're able to claim or take this income tax deduction called depreciation. So it's not what it sounds like, right? It sounds like, oh, depreciation, it's a negative thing. My property's going down in value. Why would I want to do that? It's literally a borrowed term. Okay, so it's the name of a tax deduction that says you're able to write off the entire value of your property from your income taxes over a period, a certain number of years. And the very arbitrary years, a 39-year period if it's a commercial property, or 27 and a half if it's a residential or multifamily property. And so what that says is you're able to take this deduction, essentially an equal amount every single year, and it's great, right? And one of the greatest things we talk about, real estate investing is such a powerful tool, and the tax benefits that come along with it are so powerful. Well, depreciation is the biggest tax benefit when it comes to real estate investing, because essentially you're able to write off a huge amount of your income just
Yeah.
right off the bat. So cost segregation really like puts that on steroids. Okay, so it takes the property, and just to clarify what the name means, like how it got this name, it's taking the cost, the value of your property, and segregating the components of it into different categories. So instead of saying the whole building is going to be, taking this deduction over 27.5 year period, we're saying no, the structure of the property only depreciates on that 27.5 years, but certain components like the furniture or fixtures, appliances, carpeting, cabinets, all that stuff that's interior, that's non-structural, depreciates on a 5-year schedule. So and there's a lot of other categories as well, over 7-year or 15-year, and we're essentially accelerating depreciation of different components within the property. And what that does, it creates or allows you to take a bigger tax write-off during the earlier years of ownership.
Now, how big of a benefit is this? Is this something that is minimal, right? I mean, or is this could be pretty profound?
It can be extremely profound in many cases. Now, every property is different, and there are certain cases where it's greater benefit than others. But for example, what we're doing is taking and front loading essentially these deductions. So if you imagine you have like this pool of potential deductions that I might take a deduction every year, but I might not even hold the property for that long, right? So I have this, pool in this kind of bank, and I can pull from that bank and take those deductions in the earlier years. So for multifamily properties or many types of commercial properties, on average, it's about 25% of the property value or the purchase price, really, that we're able to accelerate the depreciation of, which means we can take either that over a 5-year period or with what's called bonus depreciation, a large chunk in the first year. So yeah, it can be significant. $1 million property, and you're taking $250,000 as an upfront write-off. That's huge.
Well, first, thanks for sharing that. And actually, I've been trying to talk to some of my clients to promote this episode. I really like the way you explained it. I got a lot more. I get too much in the detail. So I can tell with your teaching background, that's one of your gifts of being able to explain it. But because I've heard this before, and you mentioned the 25%, right? So correct if I'm wrong, if we buy this house, we may be able to. We're not saying every time, but there's a potential where we could deduct in the first year about 25% of the purchase price.
Correct. Yeah, it's not a guarantee. It's not every single property is like that, but many properties on average, that's what it's going to be. So maybe more, maybe less. And there are other properties that have, on the opposite end of the spectrum, like an extreme amount. You can get up to 70 or 80% of the purchase price to take accelerated depreciation, certain types of properties.
Because as most of the time, if we're buying an investment property, because as you said, this will not work on your primary home. This is an investment property. Typically, the down payment, they're kind of around 25%, right? 20%, maybe plus closing costs. So what I'm hearing, we may be able to deduct the down equivalent of the down payment.
In many cases, correct. Yeah. And it's just incredible, because what you're saying is a really important point, is that our depreciation is based on the purchase price and not how much money we put into it, which is incredible also, because you buy $1 million property and you're only putting 25%, $250,000 down payment, but your depreciation is based on that $1 million.
Because what I'm saying, a lot of people focus on that 401k, right? They want that. They want that tax deduction, right, for what their contributions are. Those people probably aren't listening to our podcast, or maybe what soon be turned off because we're not big on 401ks. But what I'm hearing is it's very similar. If you want that tax deduction, you now have that ability, very similar to that 401k, but now you reallocate that and maybe you put it as a down payment on a property. And so we can still get that tax deduction, but now we're moving our money out of Wall Street into creating that passive income to help achieve that financial freedom. And what if somebody smart enough, or let's just they decide, hey, I got all this money in my 401k or whatever, and I'm going to free it up. And now that will be taxable, right? Because we got that tax deduction going in. But it sounds to me like, again, certain requirements need to be met. We're trying to be clear, like this doesn't fit. We're kind of given a broad term. Like this is why you need to talk with some experts to really see how this would work. But if you were to take the $100,000 and invest it in real estate, we may be able to offset the income we got from our 401k distribution. Am I correct?
Potentially correct. You're absolutely right, because and you're 100% right in saying that there's a lot of details when it comes to the tax code, right?
Yeah.
You never want to make assumptions because different rules apply to different people and different scenarios and things like that. But yes, you may be able to, if you do pull out money from a retirement account and are penalized on that, you may be able to use depreciation to offset some of those, or some or all of the penalties from that as well. So, but there's also, a lot of people are familiar with rolling over your 401k into a self-directed retirement plan, which means you can invest that without having to pull it out and without having to be penalized by pulling it out. But when doing so, in that case, most times that's a tax shelter which would not really benefit from depreciation in of itself. So I know we're kind of getting into the weeds here, but really important point to understand what your options are in terms of real estate investing.
Well, and I know there's a lot of people that will do that because the money is in their 401k and they don't want to pay the tax now. They're going to pay it, right? They just don't want to pay it now.
Right.
But then they move it into self-directed IRA and now they can buy real estate. But if they were to do that, can they do a cost segregation study?
Yeah, absolutely. You can do a cost segregation study. However, in many types of retirement accounts, if it is bought through that, the depreciation is not really going to benefit you. So if it's a Roth IRA, for example, or a QRP, which is a 401k or self-directed 401k, qualified retirement plan, those are considered tax shelters, and therefore you're not able to claim depreciation. But just a regular IRA, self-directed IRA, so I don't forget exactly what the term is, but that actually would be subject to the UBIT tax, right? And therefore the cost segregation could help to offset that tax.
Well, we did a podcast and we did a detailed YouTube study or YouTube video walking through the numbers of taking the money out. Because just as you're saying, what is great about real estate is the tax advantages. And we lose them when we put them in a government created plan. We did the math and people would be surprised. We just compared, what if we took the money out of your IRA or 401k, paid the tax hit, paid the penalty, and bought real estate, compared that to buying it in the self-directed IRA. And we did the math. So we will put a link to that in the video, but sorry to get off topic here. You get me fired up when we start talking about these 401ks.
Yonah, let's see if I can get us back on track. You mentioned something in there as far as the complexity of the tax code. I've been around kind of this industry for a while, and I feel like cost segregation is not at the forefront of a lot of conversations, especially coming from CPAs or accountants. But it sounds like it has tremendous upside and benefit. Why do you think that is? Why do you think not a lot more accountants are presenting this to clients?
From my experience, most accountants are not experts in real estate. And the tax code is huge. And so it's very difficult to find a specialist because, it's similar to think about if you have someone has a health issue, right? They can go to their general practitioner, but if they have, something specific, they're going to need to go to an expert in that field, right? And so too with taxes, the same thing. You want to have someone, if you're involved in real estate, you're going to want to make sure to have an accountant who specializes in real estate, who knows all of these things. And I literally used to give webinars for CPE credits, right? So if you're, a CPA, you know that you have to, in order to keep your license every year, you have to take a certain amount of continued learning courses, and you get these credits, and that, kind of renews your license year after year. So I was hired by this company to give a webinar, once a week about cost segregation. And they'd supply the CP credits for anyone who attended. We literally had thousands of CPAs who attended these webinars over the course of a period of time. And at the very beginning, I took a poll, okay, of the attendees. Mm-hmm. What is your prior knowledge or experience with cost segregation? So the first, A was, this is the first time I'm ever hearing of it, right? Never heard of it before. B is, I kind of heard the term, but really have no idea what it is. 3 is, or B or C, whatever, is, I have extensive knowledge of it. The vast majority, I'm talking 70 to 80% of CPAs checked either A or B, that they either never heard of it or were not familiar with it at all. And so that just, enlightened my eyes that if the CPAs themselves aren't familiar with this, then certainly the individuals, the property owners who, are not well-versed in taxes in general. And so therefore, you need to be proactive to educate yourself on the taxes involved in real estate so that, and if need be, you can educate your CPA because you want to be able to take advantage of the deductions that are out there. And the amazing thing is, this is not something that's kind of like this kind of weird strategy that's out there. This is directly from the IRS. They created the rules, they govern it. There's the cost segregation audit techniques guides you can find on the IRS's website. So it's just the fact that it's a very complex thing, and it's something that requires a third party, right? CPAs can't do it in most cases because it requires this engineering component to it. And I think that's the biggest issue, is that you have CPAs who are tax preparers, right? They're very good at numbers. They're very good at taking whatever income you made, whatever deductions you had, et cetera, and plugging in those numbers, but they're not necessarily strategists and they're not necessarily tax advisors per se. And I think that's the biggest difference.
Awesome. You mentioned a couple of things in there. One of them was this study has to be done by a third party. What's the price for a cost segregation study? And then what about the timing? When should somebody be considering doing one of these?
So it can cost anywhere from, in the time of this recording, anywhere. Our company, like I said, we're the biggest national company doing this. So from around $3,000 to $10,000 in that range. Okay. So I'd say on average, most commercial properties are going to be in the $5,000 to $6,000 range. And that, again, it's not based on your tax savings. You can have $1 million property or $100 million property, and the fee for getting it done is going to be the same because it's based on just, a flat rate based on the scope of work of the actual project. And the timing, really, the amazing thing about this, because the tax strategy, it depends. When is it going to be most beneficial? And so most people like to get it done in the first year of ownership because, set their taxes up the right way from the beginning, but it doesn't need to be done. And actually, if you've owned a property for a number of years and never did a cost seg, you can actually go back even without amending your previous year's returns and catch up whatever missed depreciation that you could have taken and do it this year. So it's really a timing issue. When are you going to benefit from these deductions most?
Okay, I knew you could go back. I assumed you had to file an amended tax return. Okay, so how far can you go back?
There's no limitation. You can go back as far as you want. However, it only makes sense really to go back a certain period of time. I'd say the best case scenario is like 5 to 6 years, where you're going to see the most benefit. Because what we're doing is we're essentially catching up whatever missed depreciation could have been taken. But at a certain point, say you've owned a property for 15 years. Well, if the entire amount of depreciation is over a 27-year period, you've already taken more than half of your deductions. So there's not much left to pull from to accelerate. And so that's really the issue where it comes from. So, but yeah, you can go back. What we do is file a form 3115, which is a change of accounting method. And you make an adjustment and essentially, like I said, catch up the missed depreciation.
Now, is there any risk? I mean, we always hear the red flags or, but any additional risk filing this form?
No, there's no additional risk whatsoever in filing this form.
Okay.
Yeah, I would say amending your returns is a bigger risk because usually when you amend returns, that really kind of opens up, the potential for an audit.
Yeah.
Yonah, you've mentioned several times multifamily commercial real estate. Are there any opportunities for cost seg on the single family or the residential side?
Absolutely, for sure. The biggest issue with single families is really the price point, okay? Because since it does cost a few $1,000s, let's say, to get one of these studies done, at what point does the math make sense that the tax benefits outweigh the cost? And my general rule of thumb is like over $200,000 purchase price. That's where it already is, much more beneficial than the cost. However, under that price point, it's borderline, and so it's still going to be more beneficial because even if you get on a $200,000 property, let's say, and you can get $30,000 tax savings, so it may be worth to pay $3,000 to get a $30,000 tax savings, right? But when you start going under that point, it's kind of okay. I have to weigh it. Is it worthwhile? Is it not? And so that's really my general rule of thumb.
The other, maybe it's a follow up to the timing. You answered it, but how would I say this? Some people are buying properties and fixing them up, right? Mm-hmm. Others are kind of holding. Is there an opportunity there, or is there a distinction that needs to be made?
So if it's a fix and flip, so you're buying it and selling it, so there's really no opportunity for cost seg, because if the hold period, first of all, is shorter than a year, then you're not really able to claim depreciation, right? If it's more transactional than rental property, and so depreciation is only for a rental property. Now, if you're holding long term, obviously that's where it's going to be beneficial for rental properties. However, there is an in between, which is if you are fixing it up and holding it, right? And so there's a point in time where you're actually changing out a lot of those components that could be depreciated at a faster rate and replacing them for new ones, right? You're renovating a property.
Yeah.
And so it does get a little bit complicated at what point to do the cost segregation study. The best case scenario is to do the cost seg on the purchase, on the acquisition, and say, we'll take that purchase price, break that down into those faster depreciation categories, and claim that deduction. And then at a later point, when you do the renovations, then we can essentially claim any money that was spent on the renovations can then be depreciated as well, and we can break down that cost.
Now, so far what I'm hearing, this all sounds great. It doesn't, doesn't sound like the cost is that much on the big picture. And of course, I would assume that fee would be tax deductible.
It's a business expense,
right?
Correct?
No, business expense. We always talk about the pros and cons. Like, what is the downside of doing one of these studies?
So the biggest downside, and I want to kind of parenthetically say that it's not necessarily a downside, but is looked at as a downside by a lot of people, is that there's something called depreciation recapture tax. Okay, mm-hmm. So anytime you sell a property, regardless if you did cost seg or not, you're going to be subject to a tax similar to capital gain tax. So if you made a profit on the sale, everyone knows you have to pay a tax called capital gain tax, right? Similarly, the amount of depreciation taken during the hold period is subject to a tax called recapture tax. And so it's always going to be less than your ordinary income tax rate, which means that the time value of money of doing the cost seg, right, during the hold period, you've taken these deductions, you're able to then, like you said earlier, right, use that money, reinvest it, gain value from having that cash flow. But on the sale, you will be subject to this tax. I keep saying subject to, because there's a big difference between being subject to a tax and paying a tax, right? As we know, there are many types of deferral methods or other deductions and things like that that can actually offset that. So for example, a 1031 exchange, which is a way to defer your capital gain tax, you also defer that recapture tax along with that. So that's an option. There's qualified opportunity zones, which is another incredible subject. Not sure if you guys have gone into detail on that on the show, but an incredible subject, which essentially was created about 5 years ago, or a little more now, with the Tax Cuts and Jobs Act, which is a strategy to defer or eliminate capital gain from any source, right? So if you made a lot of money in crypto or in the stock market or wherever, and you go ahead and put that money into a qualified opportunity zone fund, you essentially can wipe out or at least defer for a certain number of years any capital gain tax done on that. And essentially, it was created as, again, part of the way to spur the economy, et cetera. But essentially what it is, a way to kind of redevelop areas or zones throughout the country, and there's thousands, tens of thousands of these kind of areas that have been allocated in every zip code around the country to say this is an area where we'd like people to put money into to kind of revitalize this neighborhood, et cetera. So they incentivize by saying you'll have these tax benefits, incentives if you go ahead and invest money to kind of redevelop these areas. So that's in a nutshell what opportunity zones are. That's another way where, again, if you do that, you'll defer or eliminate that recapture tax. Having other deductions. So if you buy a property in the same year that you sell, you may have enough deductions from depreciation to offset the depreciation recapture from the sale of the previous property. So one may offset the other. So again, that is the biggest downside, but it's in of itself is not, black and white.
Yonah, you made a couple of sentiments there. It reminded me of a gentleman that I'm familiar with, Tom Wheelwright, right? As far as kind of reading the tax code and saying, hey, listen, this thing's outlined for us. All we got to do is go read it and apply it, right? Yeah. And tax-free wealth. And we actually have him coming up on a podcast interview as well.
Very cool.
So, yeah, very shared sentiment there.
Now, absolutely. So we create these large deductions, right? What are the limits? I know there's some limits on those being able to pass through to your tax return.
So there are limitations on to who can use them or at what point they can use them. So yeah, we create these huge big deductions, but they're considered passive losses or passive deductions and are generally limited to offset what the IRS deems as passive income. And that is real estate. Now, most people don't think of real estate as passive, but the IRS considers it passive income. So if you have rental real estate, the depreciation of your cost egg is only going to be used to offset your passive income. So this is a big spoiler for a lot of people out there who think, I'm making a lot of money and whatever I'm making money in, and I'm going to buy real estate and do a cost egg and pay no taxes. Unfortunately, that's not the case because there are those limitations. However, there are a couple of exceptions to the rule, and a lot of people use these exceptions extensively to make sure to maximize the benefit. The most prominent exception is something called the real estate professional status. Okay, so if you or your spouse are full-time in the real estate business, then those deductions are no longer considered passive, which means you can use them to offset any source of income that you have. So you take this huge amount of deductions and then apply them to your W-2 or your spouse's W-2, et cetera. And so that's the biggest benefit there is. There's another one called the short-term rental loophole, which we can get into if you want, but essentially just if you have a short-term rental and you're self-managing it, then there's certain requirements of material participating in that. But if you hit those requirements, then those deductions also become active and can be used even without the real estate professional status. So there are ways to get around it. But again, just to reiterate this, don't listen to gurus out there on the internet that say, hey, I bought a property and now I'm not paying any taxes. Well, it's misleading people, unfortunately. And you need to know that, yes, this is an incredible tax tool and strategy, but it's not necessarily going to work for everyone in the same way.
So what I'm hearing, if somebody may be limited in taking these deductions, that may minimize the benefit of doing a cost segregation study.
That's absolutely right.
Now, let's say this happens and we have these deductions and not a real estate professional. What happens to these losses? Do we lose them?
You don't lose them, even though they're called losses. They don't get lost, right? We just we carry them forward, which means they're kind of put in like this imaginary bank account on your tax return. And next year you can use them, or in any future year. And so you can use those deductions in the future against passive income or passive gains, like I mentioned earlier, from the sale of real estate. Those gains can be offset by those passive losses as well.
I'd like to add another strategy is create some income that's passive, and then you can use that against these passive losses.
Correct. Unfortunately, what the IRS calls passive is not what you and I may call passive. And so the only things that really apply to that are real estate rental property. Royalties are considered passive on that regard, or passive business interests. So not like investing in a stock, but if you actually have, invest in a business, but have a completely passive role in that, that would be considered passive income as well. There are a couple other exceptions, that would consider it an active business, and those losses would be used. Like, for example, a car wash. If you owned a car wash, that for some reason IRS deems as like an active business, even though it's real estate, the losses can be used to offset any income source. So that's one example of that exception.
Interesting. Great. Yonah, thanks. We've got some listeners that are in this space that are going to want more information. Where's a good place that they can go?
Well, you can find me on pretty much all the social media platforms. I'm most active on LinkedIn and Instagram, on Twitter, Facebook as well. But you can also go to yonahweiss.com to find out more about everything we're doing.
And you also have a podcast as well?
I do. It's called Weiss Advice.
Killer name. Cool name. Cool name.
Yonah, last question I got for you, right, is we've got listeners. Many of them are strides down the road of real estate investing, creating passive income. Some of them are just getting started. Maybe speak to those that are just getting started. Any advice for them?
The biggest advice I would say in getting started is twofold. Number one, educate yourself as much as possible. But number two, which kind of goes along with that, is find a mentor. Meaning find someone who is, 2, 3, 5, 10, 20 years ahead of where you want to be. And they've already done that. And just connect with them and try to add value to them and see if you can learn from them, because that's the fastest track to getting ahead, is essentially just, going on the shoulders of those who came before you. You learn so much more from someone who's actually done it than trying to figure it out on your own.
Well said. Yonah, thanks so much for joining us today, man. Really appreciate your time and the information that you shared with our listeners. We'll make sure that we get yonahweiss.com in the show notes so they can look you up.
All right. Thanks, guys. So pleasure.
Go make it a fantastic day.
Take care.
Mm-hmm.